I am here, yes.
Okay, perfect. And what about, is Callan, is Britt here yet?
I'm here, and Tom, I believe, is joining by phone as well.
Okay, perfect. So I'd like to call the meeting to order of the pension board. Do we have, we don't need a, this is going to be recorded, correct?
Yes, it's being recorded. I see Charlie Piero as a public attendee. Is he part of the board?
Yes, he's part of the board.
All right, I will move him over to a panelist. I remember Charlie from years ago.
He's been on the board 20 plus years,
Yes.
maybe 30 now.
All right, you're being recorded and we're all set.
Excellent. I'd like to call the meeting of the pension board to order for Wednesday, June 10th, 2020 via teleconference. I'd like to approve the minutes of the previous meeting. That's that. Any discussion on the minutes?
I'll make a motion to approve.
I second it.
Second, all in favor?
Aye.
Aye.
Yes, unanimous. We don't know if there's anybody on, but if anybody would like to make a public comment,
There is one person, Gabriel Chung. Gabriel, if you'd like to make public comment, please raise your hand electronically now through your device, and I will allow you to speak. No, I don't see anyone else. So
okay, there's no public comment. There are no pension applications this evening. So then we'll move right on to Pimco, all asset presentation. Is Pimco available?
Thanks, Frank. They should be on. Kevin Dunn and John Cavallari should be joining from Pimco to provide a portfolio review. Kevin and John, are you on?
If they're not on, we could maybe go to the performance review now.
Sure, happy to do that. Does everyone have the flash report?
I do.
Yep.
Okay. I'll have you turn to page 1 of the flash report. We show the asset distribution as of April 30th. Total assets for the pension, 413.4 million. You can see about 26.3 million in investment gains and about 3.4 million in withdrawals to pay pension benefits. All of the asset classes are within their respective ranges. You can see total equity almost directly in line with the target at 63%. Slight underweight to international. And there continues to be an overweight to global equity long short. You can see 10.6% versus an 8% target. And fixed income is slightly overweight as well, given the volatility in March. Cash was about 4.6 million at the end of the quarter. I did want to raise a few points here. One is Silchester, your international value manager, actually just opened up the strategy to new assets. If you recall, they've been closed for about 20 years. And they've let assets go out the door without replenishing them. And they believe they're at a point where they can take on more capacity. And if you recall, there's been a wait list, sometimes 5-7 years to get into this plan. We wanted to let you know that. I know they've performed very well for the city of Norwalk over the years. So we wanted to make the board aware that fund is now open. And one other administrative point, the Pantheon USA Fund 6 notified Norwalk that they are planning to extend the fund for 1 year. Norwalk originally invested in this program in 2004, and it's continuing to wind down, but there's still some investments that they need another year for them to pan out. as they liquidate the rest of the remaining investments.
Can you tell us how much is in there now?
About 2.1 million.
Thank you.
So I think in total, the fund has about 50 million or so left in investments. So enough to warrant the extra year, but it continues to wind down and is near the end of its life. So that underweight to private equity, 4.3% versus a 6% target, should continue to slowly deteriorate further as these older vintages continue to liquidate. On pages 2 and 3, we have performance for the total fund over the fiscal year to date through April 30th and longer periods. Total fund fiscal year to date minus 3.05% versus minus 0.62%. I think it's important to know that there is some noise in this total fund relative performance. Private equity and infrastructure, our returns weren't available. And a lot of the underperformance, we'll hear from Pimco, but the benchmark mismatch as the US TIPS index provided a pretty positive return of about 4% fiscal year to date versus Pimco's strategy, which is negative 8.13. And you'll hear from them shortly, but some of the underlying investments within Pimco all asset and equity like diversifiers and emerging market equities contributed to that negative return. On page 2, in terms of individual manager performance, LSV has struggled, but their deep value, smaller cap approach has really been out of favor for the last 4 or 5 years. We have been in touch. They did have a good month of May and are up over 500 basis points in June. So it's good to see them bouncing back. They're still slightly under their benchmark year to date, but have bounced back this quarter. In addition, Columbus Circle.
Oh,
Go ahead.
oh, you froze up for a minute.
Oh, I'm sorry. Columbus Circle's performed very well. You can see up over 600 basis points fiscal year to date and really strong outperformance over all periods shown. In terms of international markets, Artisan, you can see, has underperformed. They have a pretty significant overweight to financials versus the benchmark. While that has been out of favor since the COVID pandemic and really year to date, Artisan has done better and the financial sector has really bounced back in May and June. You can see Silchester, strong outperformance over all periods, continues to be a really good manager from Norwalk on that international value side. I also highlight your global equity long short managers. ABS has done very well, providing a small positive return, whereas their indexes and benchmarks are all negative across the board. And finally, on page 3, fixed income slightly underperformed the ag. As you know, in March, during the sell-off, investment grade credit, the riskier parts of the fixed income market, really struggled as the flight to quality and safety drove investors, and there was some slight underperformance there. And lastly, your absolute return manager, UBS, has done very well, returning about 2% fiscal year to date, up about 700 basis points over the hedge fund conservative index. That was the quick version. As I see that our Pimco friends have joined us. Any questions on performance before we jump over to the Pimco presentation?
We want to discuss cash needs at this stage of the game or no?
Is Chitsame on?
I thought we were good for cash through very late in the year because we get the city's contribution at the end of this month.
Okay, I remember that.
Yeah, I think we're good through like November or something, so I agree, probably.
Okay, good.
Okay.
And how much capacity do you think we could have for the fund that's opening up.
We would, if the board is interested, we wouldn't recommend more than an incremental addition. You have a growth value structure in international developed markets. Artisans, your international growth manager. Silchester's your international value manager. So on the margin, you could add up to 2 to 4 million would be our recommendation if the board was interested.
I mean, they really have a unique approach. They're very, very, very different, and it's been successful. I would have no problem at all with something in that range.
Yeah, can you hear me, Rich? This is Tom.
I can, Tom. That's a nice photograph over your head. I don't know where it begins and your head stops.
Yeah, I'm having some video issues, but we do think it's a compelling opportunity. As you said, Rich, there are many differentiated aspects of what they do. In their process, their results speak for themselves over the long term. And as Britt said, this strategy has been closed really for a couple of decades, and they're looking to solicit new money. The current wait list is actually still about 4 billion, but you've got all these clients looking for liquidity or not looking to add more. And between now and the end of the year, they're potentially going to take new contributions. And this, if it was in that range, what Britt was talking about, it's an incremental add, and it has that value tilt, that smaller cap, but it's, we believe, a good entry point. It's an incremental addition to where you are. It's not a big deviation in the overall structure for international equity. So we wanted to bring it to your attention. We think it's a potentially exciting opportunity.
When do we have to make a decision?
They're saying it's between now and the end of the year, but given the time horizon of Norwalk, we don't see, you don't have to make a decision today, but our preference would be to put in money at this entry point or in the next few months than waiting. We don't know where we're going to go short term, but if you look at the valuation of the portfolio, we still think it's a good entry point.
Yeah, I would agree.
You know, one thing about it is, if you look at the last 7 years, the MSCI value index is actually down, and where U.S. long equities up 10% over that period of time, Silchester's up 3.8. I've always been kind of one who rather buy strength than buy weakness, and to have a negative return over 7 years in this kind of a market is disappointing at best for the I don't know if you see that or agree with that.
No, it's not the manager. It's not the manager, Frank. It's the market.
Yeah, and
International
Right.
okay.
is
But,
U.S.
you know, and there are different markets that do well, and you know, there are markets. There are, you know, tech stocks as a part of the market, for example, is doing well, and you know, retail doesn't do well, and the value index for developed markets hasn't done well for a very long period of time. And I'm not a believer that somebody's due, because you could have looked back and said, well, 3 years ago, 3 years ago, long equity in the United States was up 6.5%, and the value index was down 5.5%. You know, you could look back a year, one was down, U.S. long equity down 4, this index was down 20. 3 years ago, it underperformed. 5 years ago, it underperformed. 7 years, it underperformed. So it's just been a steady underperformer. So. I think the other thing is we don't really have cash now until we get money from the city, and we don't know exactly how much. I think it's around 12 million. But
And Frank, this is Britt. I don't think we would recommend taking from the US equity allocation. I think if we're going to incrementally add to Silchester, it would be within international equity. You still have that target to international. We're not trying to deviate from your strategic asset allocation. It's more on the margin. If you have conviction in Silchester, yes, value has been out of favor both internationally and domestically for years. But Silchester, relative to their benchmark, has done exceptionally well. And Callan is a believer that at some point value will outperform growth. Whether that's next year or 5 years from now, we don't know. But that's why we believe in a diversified approach.
You can always reallocate Zeisinger's money to him.
I want more of a pop than that.
Well, I think what was mentioned about the contribution would make the most sense, because if you look at the relative weight of international today relative to the target, I think what would make the most sense is part of the contribution.
Yeah, I could see that. And then we could always take something out of fixed income if we wanted to round it up to make Frank happy.
That happens in July, correct?
Yeah.
I believe so.
That's the end. Yeah, it should be. I think the fiscal year ends June 30th,
Right.
and we would get our contribution sometime in July.
Hi, this is Chitsame. Normally we do, the fiscal year starts July, but we normally get influx of cash like July, August. So around, I think last year it was end of August or early September that I sent the entire contribution. But I think this year we're going to use some of that contribution to pay the regular pension monthly payments.
Mm-hmm.
Yep.
So we could discuss this when the money's available. We're not going to use the rest of the cash here, right? We're not going to rebalance or reallocate now.
I don't believe we are.
Are we going to meet the next month, Frank?
We could if we're doing, I mean, it might be, depending on what the city's doing, we could possibly have a meeting in person if City Hall is reopened. But I think that'll be something, probably if Ray has any comments on that.
Well,
I don't think you should count City Hall being open for a July meeting.
So I guess the other question I have is, Britt or Tom, is there any new information we're going to get before we would make a decision on this? Britt, Tom, do you hear?
Now,
I think,
yeah, go ahead, Britt.
I was just going to say, I'm not sure what else we would hear from Silchester that would kind of inform the decision any further.
Yeah, and we could do it at the September meeting, Jim, because usually there is not a July and August meeting. If we were meeting in September, they're opening it up through the end of the year, so the September meeting is also fine.
Yeah, I personally, I'd be in favor of putting some money there. I'm not sure what the right number would be, but I like Silchester.
They were very unique, and they deliver results.
Could Chitsame, I was wondering, the cash was 3.2 million for last month. How much of that was payments for the pension?
The pension, it's around 2.2 million. So currently we have about 2.5 million that's left that I see, and I will be drawing down about 2.2 of that money to pay this month's pension distribution. But there are also pension contribution from our current employee, which is around 300,000.
So you have
So by
enough
the end
money,
of June 30th, we'll probably have, I would say, 500,000 in cash.
But then, so based on that, we would need the city's contribution to make July's payments, right?
Correct.
Are we sure we're going to get that?
Well, we're
Well-
gonna pay, it's basically pay as you go. So when we pay the July month, that's how much we're gonna contribute until we get to the total level of, you know, the 12 million that is set aside for the fiscal year 2021.
And we're good.
Yes.
We're good. That's discussing Silchester until we have the money in the bank.
Well, how much are we talking about here? Well, is there a number that people have in mind?
What I heard was 2 to 4 million.
3 or 4?
You're somewhere in the 2 to 4. Yep.
Oh, 2 to 4, okay.
one of the things, by the way, is we're going to get the $12 million, and that's going to pay for the pension about November. So we would then have to get cash then anyways. So where would you take it out of? Silchester's, as it is, Silchester is the largest amount of money we have with anyone, I believe, except for the index fund and the bonds, the fixed income.
Well, that's by a marginal amount, Frank. It's 10% over what's in Artisan. So I don't know whether talking absolute numbers is a fair comparison. But the reason why it's larger is because they've actually outperformed.
Outperform their index, not the.
Yeah, they haven't outperformed. Their performance is not high. It's just that.
Well, it's not a fair comparison in the fact that you're comparing them to the index, not to other active managers. And they've outperformed other active managers relative to their benchmarks. And to say that the reason why we shouldn't give them more money is because they're the most successful active manager is a little circular to me.
Well, you know what? I remember one of the first times I bought stocks. I bought Bethlehem Steel, and they said, you know, everybody always needs steel. And right now we're looking at value index in the MSI, and it's been a negative performer for 7 years. So
No, I want to stick on you. I want to address the argument that you made that they're big relative to everybody else is a reason not to invest in them. And I'm saying that that's not a valid argument. I don't want to change the subject.
Well, we already have a lot of money with them. We've almost 10%.
Wait.
I don't disagree with that at all. But the reason not to put more money in them because they're the biggest active manager we have, and it's because they've actually succeeded. Yeah, I question that logic.
Okay, so they've succeeded. In U.S. long equity has gone up 10.6%, and they've gone up 3.8%.
So fine, Frank. Sell all the active managers and just put it in the Russell and the S&P. Fine, go all passive.
Well,
you know, if we're going to have active managers, let's evaluate the active managers. It's not the discussion to have is whether we should be all active or all passive. We've decided we're not going to be all passive, and so we're allocating to active managers. And so it's not fair to compare an active manager to the benchmark. It's fair to compare them to other active managers.
I think you both bring up valid points, but we're talking apples and oranges. We're not talking active and passive. We're talking about international versus U.S. markets at this stage. We're not talking about active versus passive.
But we have to compare U.S. active managers versus the international active managers. It's not fair to compare them to to passive U.S. managers.
Right, but one of the things I think you gotta look at is where the funds are. Artisan has underperformed the index over the last, because we haven't had them for 7 years. They've underperformed the index, and even though Artisan's underperformed their index, in that period of time, they outperformed Silchester.
The way I'm looking at it, we're underweight international slightly. We're overweight fixed income. Let's take it from the fixed income bucket, right? I mean, we're overweight fixed income. It looks like U.S. equities are spot on as far as our allocation goes. If we're going to take the money somewhere, let's take it from domestic fixed income.
Well, why do we have this discussion in September when we know what kind of funds we have? Is that reasonable?
That's reasonable, but I just want to make sure that we're as Joe says, comparing apples to apples and oranges to oranges.
All right, we'll agree to pick it up in September.
Yep.
Sounds good.
Okay.
All right, what's next? We have
Pimco.
Pimco on?
Britt, is Pimco ready?
Yes, this is John Cavalieri from Pimco here. I'm ready. If you guys on?
We're ready.
Okay, great. Kevin Dunn, are you on the line also? I guess not. In that case, I'll just kick off. I'm on the all asset team. Again, my name is John Cavalieri. I'm an executive vice president at Pimco. I'm on the all asset team. I've been with Pimco for 17 years. I apologize that my video isn't coming through. I'm using Tom's login, so I'll just use my voice at first, and then I'll try and upload I'll see if the presentation uploads. If not, then this will just be audio only.
John, I just joined, sorry.
We have the presentation.
Okay, great, Kevin.
Yeah, sorry about that. All three of us were logged in as Tom, and he was performing a miracle as 3 different people, but I figured it'd be easier if I joined a different line, and maybe it would help John's video as well. So sorry about that.
Maybe if you, Kevin, since you're on the relationship, maybe if you want to just do a quick opener as well as a time check, and then
Sure.
I'll move over to the fund when you're ready.
That'd be great. Sorry for the technical difficulties here. So my name is Kevin Dunn. I had the pleasure of meeting several of you back in November 2017, which I believe is the last time we came up and presented to you. First and foremost, I'd like to thank you for the long-term relationship. We just passed 15 years that you've been in the strategy, so we appreciate your long-term approach to investing and the long-term partnership. John just introduced himself. He's one of our senior asset allocation strategists who works directly with research affiliates, the firm that we partner with. And with that, maybe I will try to share my screen and go right into the presentation and provide a quick overview of the strategy, and then John will dig in a little bit deeper on the strategy and also discuss performance, our outlook overall for the environment and how we're positioned in this environment. So let's see if I pull it up here. There we go.
This is the PowerPoint presentation, right?
Correct.
Yep.
So here it is right here. So quick time check. I think Britt, Tom, you mentioned about 30 minutes. Is that correct?
Yeah, that'd be great. Thanks, Kevin.
Yes. Yeah.
Okay, absolutely. So let's dig into what is the strategy, or why did we create the strategy in the first place? So City of Norwalk came in April of 2005, about 3 years after we started the strategy. The strategy was started in 2002 after the tech bubble blow up and also the accounting scandal of WorldCom, Enron in 2002, 2003 timeframe. So right as that was happening. And at that time, having a typical stock bond portfolio wasn't enough to protect investors. And we wanted to create something that really focused on protecting against inflation and protecting against the volatility of the stock market. So the all asset strategy was really developed out of that. So the main goals are on the far right, as you can see on the page. We seek to deliver attractive real returns after inflation, diversify away from equity risk. Historically, our beta has only been about 0.3 to 0.4 to the markets. Provide inflation protection, because bonds certainly don't do well in an inflationary environment, and equities do okay in a small inflation environment, but if inflation picks up a lot, equities tend not to do well. And we try to do this with moderate volatility. Historically, we've been able to do this with 8 to 9% volatility. How do we do this? We focus on third pillar or diversifying assets. We allocate using a value oriented. You spent a lot of time discussing Silchester and its value orientation. We also have a value oriented kind of contrarian process where we try to find cheap assets that we think have a good chance of appreciating and find good value for them. And we combine the expertise of two firms. We talked about Pimco. We manage the 50 or 60 underlying mutual funds that are in the strategy. And we blend that with the top-down asset allocation that comes from research affiliates that really focuses on doing a lot of deep research on asset allocation and also equity investing. So what is our approach? If you take a look on this slide, the traditional balanced portfolio has historically had about 50% to equities, 30% to bonds, and then you see the green ring of these diversifying inflation-related assets. What we try to do with the strategy is actually flip everything inside out, and we really focus on these diversifiers. So we want to provide that inflation protection through tips and commodities. We focus on higher yielding strategies like emerging market equities, global credit, global and emerging market bonds, and liquid alternative strategies that provide some dry powder, but you can still retain a nice yield if there's uncertainty in the markets like we've seen over the last few months. And we tend to use less of these mainstream equities. We're trying to diversify away from US equities. We use a little bit of bonds in the portfolio when they seem attractive or we need more dry powder. But you can see these diversifiers on average make up about 77 to 80% of the portfolio over time. And the strategy is tactical. We move in and out of these different asset classes, and we talked about kind of the low allocation equities, and the red that you see at the bottom of the bar, reddish colors, those are kind of allocation equities, and you can see it hasn't been very high historically. The bluish colors are more of the bond allocations, and we've moved in and out of those depending on what's going on in the different market environment. You can see we added a lot of bonds during and before the financial crisis, and that held up quite well. And we also did so over the last 2 or 3 years as well. And then the green, where you see most of our allocation, are these diversifying asset classes. We talked about emerging markets, equities and bonds, commodities, inflation-related asset classes, credit, and alternative strategies as well. And as things get cheap, we rebalance into them, and as things get expensive, we rebalance away from them. So you can kind of almost think of it as an automated rebalancing strategy into diversifiers. And then why do investors typically use it? On this chart, you see the typical return and volatility charts that Tom and Britt have probably showed you quite a bit over the years. And you can see where core bonds are on the far left, kind of lower returns, but lower volatility, and stocks on the top right corner. And these diversifiers, this equal weighted of these 6 kind of home base of where we invest, kind of falls right on top of a 60-40 allocation. About similar volatility, similar returns, but why most people really invest is on the far right. You can see the 60-40 allocation is really driven volatility and risk-wise and return-wise, but approximately 90% by the S&P allocation. Diversifiers provide kind of a much kind of different kind of return pattern and lower correlation. But this doesn't come without some risk as well. It can be a little bit of a bumpy ride, and on this chart here, you can kind of see what it feels like. This chart, the green bars represent the equal weight of these diversifiers, our home base or where we invest, and the green bars are the outperformance over the 60-40 allocation on any given year, and the maroon bars are the 60-40 outperformance years when it tends to do well. And you can see it's almost like the value growth charts. You don't invest just in value stocks because there's times like the last 10 years where growth stocks have really done well, but there are also time periods where value does well. And you can almost overlay that large cap growth, large cap value with almost this strategy here. You can see 60-40 did really well during the tech bubble run up. But as things got expensive, people were paying for, names that had no actual earnings, and the tech bubble actually blew up. People got back to value investing. Why is value important? What's your price to book? What are you actually earning? Those sorts of things. And value came back in favor, basically from 2000 to 2007, up to the financial crisis. So these things have rhyme and reason. Value comes in favor, growth comes out of favor. And after periods where growth or 60-40 tends to outperform, we see these diversifiers tend to outperform for a few years after that. And we think we're pretty well poised, and there's a really nice yield on the portfolio. We think this is a good time to be invested in this strategy. And John, I'll turn it over to you.
Okay, thank you, Kevin. Can everybody hear me okay?
Yep.
Can anyone not hear me okay? Okay, hearing nothing, I'll move forward. Perfect. Great. Kevin, I guess you're on the controls here.
Yes, John. So just tell me what page you want to go to.
Okay. Would you please go to page 11? Okay, I'm going to review, I'm going to kind of briskly review, because I know we're on the clock here, trailing performance for the quarter, also for the year-to-date period. Then we're going to talk about changes we've made in the portfolio as a result of the market volatility, which has created some interesting opportunities. First, we're just going to review markets. You've reviewed markets, so I'm going to be very brief here. And this is for the quarter, so I'll talk about the year-to-date as well. But for the quarter, which captured the majority of the COVID stress, everything was down. Those are the solid bars here, except for, of course, treasuries or core duration, and that's the blue, core bonds. But if you're a risk asset, you are down, and down pretty meaningfully. As Kevin said, the All Asset Fund focuses on the diversifying asset classes, which are shown on green on this page and throughout the presentation. If you just look at the box, if it's hard to read, I'll read it. The average return across these diversifiers, which again is our home base, was negative 16.8. Ouch. So without knowing anything else, that should tell you that the All Asset Fund was probably down about that much. And indeed it was. I'll just read the, we don't have the quarterly number right here. But we were down slightly less than that for the quarter. A lot of folks have said, well, geez, I've become so accustomed to the All Asset Fund buffering downside so well when equities decline. That's true. In many cases, that's the case. If you go to the following page, page 12, we're basically showing you the same chart here, except instead of just showing returns, we're also plotting the returns of the asset classes relative to the risk. So it's return versus risk chart, again, for the first quarter. And what you can see, that diagonal line, all the risk assets fell almost perfectly proportionally to their risk. And on that line represents a -1 Sharpe ratio. In other words, if you have a 10% average volatility and you fall 10%, that's a Sharpe ratio of -1. All these assets fell almost perfectly proportionally to their risk. That's what we call a nowhere to hide market. Diversification, it doesn't matter if you're diversified. It doesn't matter if you're in cheap asset classes or rich asset classes. There's no differentiation. Everything fell proportional to its risk. And so that's really why for the first quarter, you had the All Asset Fund decline more than folks thought, more than their intuition suggested. If we go to page 13, page 13, we show our standardized returns. We also start showing on the far right-hand column our year-to-date returns. Now this is through May, and the portfolio had already rebounded to -8. If we fast forward through today, the portfolio's rebounded up to just -3. So there's a lot of a lot of rebound that's not reflected here in this book, but is in the actual pricing. I'll note a couple other things. One is that from the inception of your account, back in April 30, 05, that's the left of the table, your annualized net of fee return is 4.6%. I want to call out one other thing here, which is that some folks have said, geez, well, the five-year return for this fund is relatively low. It's only 2.5% net of fee, and that's for 5 years. What's going on there? Well, if you go back, Kevin, to page 11 briefly, we'd show you that the 5-year average return for the diversifiers, again, maybe you can read it in that green box in the upper right, the average return for these diversifying markets over the last 5 years was negative 0.6. That's what our home-based markets gave us. So when viewed relative to what our home-based markets gave us, negative 0.6, back to page 13, the 2.5% annualized return over the same 5-year period, and that's a net of fee return, actually shows pretty considerable value added by the All Asset Fund. It tells you, number one, that the low level of absolute returns in recent years is really explained by the markets, not because of some portfolio management mishap or misallocation on our part. Number two, it shows you that relative to a hypothetical do-it-yourself portfolio in the same markets, the fund is giving you significant value added net of fees on an annualized basis. And then as we move to page 14, you can see, taking a longer term perspective, we look at the return of the All Asset Fund here in blue since its inception, and we compare it to the TIPS primary index in green, which also has basically been flat, you'll see, for the last 5 years, actually for the last 7 years. And we also compare it to the dotted line, which is our secondary benchmark, which is really just uninvestable aspirational return, long-term target return of CPI plus 5. And you can see the fund has done a pretty admirable job of tracking with CPI plus 5 over long periods of time, sometimes a little above it, sometimes a little below it. You'll also notice that, of course, there are periods of drawdowns. Period in 08, end of 1915, which is a big disinflationary crash. That was when oil crashed and emerging markets revalued. And then the more recent period here in 2020 in the first quarter. This is not to worry. This doesn't reflect permanent impairment of the strategy. It just reflects periods of market stress from which we usually bounce back and then some. And that's really.
I got a quick question.
Yeah, let me pause there.
Looking at that on the chart on page 14, in 02 to 20, what period of time in that it was the most inflationary, would you say?
The most inflationary was absolutely the roughly the 02 to early 08 period. In fact, oil peaked in May 2008 at over $150 a barrel.
Okay.
You'll recall that's.
Yep.
Yeah, sorry, please go ahead.
I think the way that I look at this fund is an investment in our overall fund as an inflationary hedge. That's what I think, the way that we look at this fund. Would the rest
absolutely.
Would the rest of the board agree with that?
I agree with that.
Right.
So that's what we're looking for. So during that period,
absolutely.
you outperformed.
Yeah, that was the big commodity super cycle. China pulling away, 10+% growth, building cities all over, consuming all the commodities. Following that and the financial crisis, that was kind of just a rebound period in terms of the post-financial crisis era, and then we actually had a disinflationary period after that. In fact, if you turn to page 15, this is kind of an interesting chart. When I refer to these diversifiers in green throughout the book and here on page 15, a key element to what gives these diversifiers their diversifying attributes is the fact that they're positively correlated to inflation. Mainstream stocks and bonds prefer low to disinflation. Diversifiers whether it's your TIPS. And by the way we define this green mix of diversifiers, it's TIPS, commodities, and REITs. So your classic inflation fighters, and EM stocks, local EM debt, and high yield, which we call stealth inflation fighters because they actually have very pronounced inflation protection attributes, even though folks don't typically think of them as inflation fighting assets. An equal weighted mix of those six is this green line here. From the lows of the financial crisis on the lower left, these markets and stocks all rebounded together on the heels of a lot of fiscal stimulus, remember quantitative easing, Operation Twist. What really happened was the taper tantrum. The taper tantrum marked a bifurcation of returns, which is extremely vivid on this chart. Basically, it was when you recall then Chairman Bernanke spoke about the potential of removing or tapering quantitative easing, and it spooked markets dramatically. There was a big sell-off in real yields. Risk assets sold off globally. Big flight to quality, except somewhat counterintuitively, the flight to quality didn't go where you think it would go. Normally it would go to treasuries, but treasuries were the target of the taper. So it didn't go to treasuries. It didn't go into cash, which was yielding zero. But the counterintuitive part is that the capital flew into what folks perceived as the next best, I suppose, liquid, high quality market, US stocks. I propelled this massive divergence of US stocks versus everything else. You know that from looking at your own portfolios. Anything not called US stocks over this 7-year stretch here since May 2013 hasn't kept up. Well, look at that diversifiers line. It's basically flat. In fact, we quantify it up in the box there. It has an annualized return of negative 0.9% since 2013. That's all assets home base. Those are our home base markets. So the market has given us nothing to work with in terms of driving returns over that period. And a lot of that has been a disinflationary period because you've had, following the commodity super cycle and following the big decoupling was the key word, describing China's accelerated growth and emerging markets pulling away. You've had a big revaluation in emerging market valuations, a big slowdown in China, and a big deceleration in commodity prices, actually hitting, in terms of oil, hitting not the all-time low, but I'll call it the secular low point just recently. So this has been a disinflationary period that's weighed on these diversifying markets, and so that's been a headwind for our ability to drive higher levels of absolute returns in recent years. Now the flip side is, if all these asset classes have had a net zero return for 7 years, what does that mean? They have positive yields, but they must have had price losses that offset their yields such that the total was zero. So these assets have ratcheted cheaper and cheaper and cheaper and cheaper over this time period, and now on a forward-looking basis provide a much elevated return expectation relative to mainstream stocks and bonds. And that's, of course, part of the diversification cycles that Kevin talked about at the outset, and that's the effect that we look to amplify in the all asset fund.
Can you run that logic past me again?
Yeah, sure, of course.
That stuff's cheap and therefore it's going to return? Is that what I heard?
If an asset class, yes, basically, if an asset class has a positive yield but has a zero total return, that means it's had a capital loss that's offset the positive yield.
Correct.
It's gone down in price. Right.
Correct. Yeah.
And if that compounds over 7 years, that means those assets are persistently getting cheaper and cheaper and cheaper.
Agreed.
Such that when we look at them today, they have the favorable initial conditions of low starting prices, elevated starting yields, and therefore substantially elevated future looking returns.
Well, can't the yields go, isn't there more than one way of handling that if the yields go down? Isn't that another way to reset prices?
The yields are going up.
Well, what if the yields go to zero?
If the yields go to zero, then the price will shoot up.
we're still at the same point then.
Yields on government securities are approaching zero, but I'm not talking about yields on government securities. I'm talking about yields on risk assets.
I understand that.
Yeah.
But I just think there's a bit of circular logic there. That's all.
Okay, I'm not sure I follow your perspective, but
that's fine.
Maybe okay. Maybe just for the sake of time, we can move ahead because this is related. You know, page 29. What I was basically saying is, as asset classes get cheaper over time, their expected future returns go up and up. It's the same logic as buying stocks on a dip. Your expected return on stocks is going to be higher if you buy them on the dip than buy them on the peak. These diversifying markets in green, which we show here on page 29, pardon me, have been ratcheting lower and lower in price over the last 7 years, and they therefore now have significantly elevated returns relative to mainstream stocks and bonds, which have been ratcheting higher in price, or said differently, lower in yield. The bottom line, this is what we show on this page are our, call it roughly 7-year expected returns. Now, these are real returns. This is net of inflation. If you want, you can add roughly 2% to these numbers if you want to think in nominal space. But the main takeaway is boxed. You know, U.S. stock and bond blend, a 60-40 blend, is priced today to deliver about 1% above inflation over the next 7 to 10 years. Not terribly compelling, but not entirely unexpected given that they've outperformed expectations over the prior 7 years. Opposite case for the diversifiers. They've, as I said, had a flat return, which means a decrease in aggregate price. So today they have the benefit of elevated starting yields with lower prices and therefore higher expected future returns. Just an equal weighted mix of these passive markets, by our work, suggests are priced to return 4% roughly above inflation on an annualized basis over the next 7 to 10 years. That's just passive markets. Now, in all asset funds, we're not passive. We implement through actively managed Pimco funds, which have historically delivered roughly 1% in excess of their benchmarks, net of all fees and expenses. So bump that up to CPI plus 5. But we're not equal weighted either. We're emphasizing higher returning over lower returning asset classes. So maybe bump it a bit higher. So as we look ahead, you know, we have a great deal of confidence that this diversification cycle is on the verge of turning into our favor. And as it does, it has the potential to unleash this return potential, which could mean a multi-year run that would be consistent with CPI plus 5, which, by the way, would be consistent with what the fund has broadly delivered over the balance of its now 18-year life. So the flip side of you know, lower trailing returns is that it gives you an elevated future return. And then lastly, I'll just show you on page 33 some of the shifts that we've done in the portfolio over the last quarter to take advantage of the market volatility, where we rebalanced unemotionally into these newly distressed prices. Again, the flip side of a nowhere to hide, the downside of a nowhere to hide market is it pulls you down. The upside of a nowhere to hide market is if you can then rebalance within that dip, as markets rebound, you can get much more than your fair share. And you can see that's exactly what we've done between December 19 and April 20th, which are the segment of 3 bars on the far right. We went from no U.S. equities to 5% in U.S. equities. We went from 6% in developed U.S. equities to 14%. Those are 2 big allocations in because the market values for those markets were declining over time. We funded those out of the blue, which was our bonds, also the two pale greens above it, which are our defensive alternative strategies, and our inflation-linked bond, basically long tips, another defensive area. We started increasing our credit allocation as credit spreads widened. We retained our emerging market bond emphasis, but we increased commodities and REITs, two markets that got absolutely bludgeoned and were now priced well below long-term equilibrium levels. We retained our EM equities emphasis, but we didn't top up to it. We just let market moves move that lower because we had so many other markets sell off that enabled us to diversify into a much more diversified return-seeking risk-on basket. Let me share one last thing, and then I'll pause and take any final questions. Kevin, if you move up to page 18, I just want to draw a comparison of what we've seen here in the first quarter in terms of the COVID stress to the global financial crisis, which was really the best parallel, not the mid-cycle corrections. The global financial crisis was another nowhere to hide market. S&P back in 08 to 09 had a peak to trough drawdown of 55%. It subsequently rebounded 72% over the next 12 months. People think, well, isn't that great? Well, looks great, but if you work the math, you're still not in the black. Down 55, then up 72, only takes you to about 80 cents on the dollar. You're about 20% cumulatively behind where you started. Why? Because it's a static exposure. So the key is to not be static. The key is to be dynamic. Back in 08, the all asset fund drew down similarly to what we drew down, though a bit more, down 24%. We subsequently rebounded 41%. When you do that math, you come out about 7 percentage points ahead. Going from down 20% to up 7%, that's a big win in that drawdown and recovery. And we were able to do it because when markets drew down, we unemotionally rotated back into risk markets so we could asymmetrically participate in the ensuing rebound and drive cumulative positive returns. That is the same playbook we're using right now. Nowhere to hide market, peak to trough. This isn't the quarter return, but it's the peak to trough as measured by the S&P. S&P was down peak to trough 34% if you round. The all asset fund was down 21% if you round. But as I showed you, we've made significant rotations within the portfolio to a much more risk-on posture in the face of recently cheapened markets, such that over the next 12 months, we're only 2 months, barely 2 months after the trough, if it proves to be the trough. And we've already made up most of our decline. You know, another 10 months from now, we're cautiously optimistic that that's going to be a similar result as we've seen in the past, which is driving cumulative positive returns for our clients, and then hopefully off to the races from there. So hopefully we've been able to provide a brief overview of the strategy, a recap of what happened in Q1 and year to date, tell you what we did within the portfolio to take advantage of the volatility, and show you a parallel experience to give you an indication of what we're driving for in terms of future return potential. Let me pause there and see if there are any questions.
We're almost to the we're almost to the second quarter where, you know, what's the NAV look like?
Yeah, so our year-to-date return now is -3. So like I said, we've made up almost the entirety of the declines. The return for the second quarter in isolation is nearly 15%. So quite good. If by contrast, we look at what was an equal weight of the average return across those diversifying inflation sensitive markets that we've been referring to, those markets have returned 12. Again, the fund has returned nearly 15. So we're moving with our diversifying markets, but we're giving you more than net of fees than if you tried to do it on your own.
What's the current yield, John?
Oh yeah, the current yield, great point. Thanks for the prompt. The current yield is 5%. So again, when you think about a long-term aspirational target of CPI plus 5, well, if you're already yielding 5, all you need is CPI for capital appreciation, or zero real growth. We like that. We think that's why. That's the other way of looking at it. While we're optimistic that we can drive some pretty compelling returns over the multi-year horizon.
Do you think that your CPI plus 5 is a little overly optimistic because, like, say, for the last 10 years, you've underperformed that by almost 250 basis points? The last 5 years, by 400 basis points?
It's obviously not a calendar year target. It's just it's like putting the number 7 up there. It's not something that you can invest in. It's definitely an aspirational target. It's definitely an ambitious target. From a market peak, it's a difficult number to achieve. From a market trough, like what we're just coming out of, it's absolutely achievable. In general, it's harder to do in the current environment relative to 2002 when we launched the fund, because yields are so much lower today than they were back then. But at least from today looking forward, for the next multi-year horizon, as I described, we think CPI plus 5 is achievable.
And Frank, just to go back to page 14, which John already covered, the trailing returns that we went over are very endpoint dependent. So very tough year for all asset classes. So that really affects all trailing returns going back. If we were talking in 2016, 2017, 2 very good years for the fund, we would be showing much higher trailing returns all the way back. But this chart here, the blue, you could see probably well over 50 to 60% of time, we have been above the CPI plus 5%. And you can't invest in that, right? If we could all invest and get CPI plus 5%, we would do it all day long. As John said, it's an aspirational goal. It's something that we're targeting over the long term, and we've been able to do it for a good proportion of the time that we've managed the strategy. It just, at this point in time, this endpoint, not looking attractive, but historically, this is a good point where typically we start bouncing back and outperforming CPI plus 5%.
And you had a real, go ahead, Frank.
No, I was just going to say, well, we've had money with you since April of 2005, and you've underperformed. So that's a long period of time, 15 years. And you've by your CPI plus 5, if I read this correctly, you've underperformed by 225 basis points. By which
I wouldn't characterize it underperforming for 15 years. And the reason is, the presentation here is printed as of the end of March. So that's printing at the low point of the decline of all the markets. So when you do that and you look backwards, all your trailing returns look low from that specific point of time. But like I said on which slide was it? Slide 14. When you look on a rolling basis, the fund has very consistently been at or very close to its CPI plus 5 long-term target. Now, the last 7 years in particular, it hasn't. If you just focus on the last 7 years, and the last 7 years it hasn't because, like I said, the diversifying markets, which is the home base markets for the all asset fund, they've delivered basically zero return. So we can't deliver CPI plus 5 or a 7-ish type of return when our home base asset classes are giving you zero, technically zero, negative 0.9. So this has been a period where we haven't been able to achieve CPI plus 5, but that creates elevated future return potential. And so that's why going forward, we think CPI plus 5 is absolutely achievable.
I think what's smart when you look at
what do you see inflation being in the next couple of years? Because today when the Fed chairman, he kind of implied that rates were going to stay at the lower range for the next couple of years.
Again, the strategy doesn't need elevated inflation to deliver its goals. The strategy, it will tend to outperform mainstream stocks and bonds when inflation is rising. And the mainstream stocks and bonds tend to outperform us when inflation is moderating. So even if the Fed perfectly hits 2% forever, there's always going to be periods of cyclical elevating and rising and falling inflation around that central tendency. When it's rising, it gives us a tailwind. When it's falling, it gives core assets a tailwind. Of course, if there's a breakout, which isn't in our forecast for the next handful of years, if there's a breakout to the upside, that's an added tailwind to us. We think there is potential for a breakout, not in the next year or two, but potentially as you look out maybe 7 years or so, because that's when you start, about 12 years, I'll be brief, but about 12 years from now is when you start having the huge debt impact fall on the national balance sheet in terms of Medicare, Medicaid, and Social Security. And that's when the debt to GDP just starts going hockey stick, because these are huge unfunded liabilities. The marketplace is likely to recognize that in advance, and that has the potential to create a big inflationary cycle, depending upon how it's handled and or said differently, a dollar decline. So that's not in the near-term horizon, but I think when you start getting out 7 years and beyond, then that starts coming into the picture. So that's, I think, the only kind of plausible, big-time inflation breakout that we would foresee at this time.
Thank you.
So your strategy right now is a bet that the deficits in the U.S. are inflationary?
No.
Is that what you need to happen for this to work?
No. The strategy does not need elevated inflation to deliver its returns.
Okay.
In fact, all it needs is, the strategy first and foremost is a value-oriented strategy. So we've just come through a period where a lot of markets have sold off significantly, a third of their price. Everything is slashed by 33% off. Yet the underlying fundamentals, once you look through the relatively brief COVID period, even before us, are largely unchanged in our view. So we've got a great opportunity to drive returns because we just bought a lot of assets on the cheap when a lot of folks were afraid to do so. If, as inflation expectations normalize, inflation expectations fell way too low. They fell to a low of 0.5% annualized over 10 years just 2 months ago. As those normalize back to levels that are actually going to be achieved, not 0.5, but something closer to 1.5, as that normalization of inflation expectations moves up, that's another tailwind for the strategy. It doesn't mean inflation has to go runaway. It just means as it normalizes, as markets calm down and rebound. So those are the types of tailwinds that we see for the near future. We're not anticipating any kind of runaway inflation. The runaway inflation, as I mentioned, that's a potential for multiple years down the road, but we're not positioning for that. Of course, if there's surprise inflation, let's say, 2021 or 2022, again, not our base case forecast, but if there's surprise inflation, even if we're surprised by it, the fund will naturally do better than most other strategies because our natural home base is in these inflation-sensitive asset classes anyway. So it gives us kind of a structural basis to outperform if there's a surprise. And if we anticipate those episodes, we can amplify that effect. But again, that's not in our near-term view.
So at the end of April, you were, I think it's slide 33, your U.S. and developed non-U.S. equities were 19%, I believe. What are they today, roughly?
Yeah, Kevin. So maybe if you jump to slide 33 again. So actually, they're about these levels because they grew a little higher from risk assets in general, grew a little bit higher since the end of April, primarily because markets were continuing to rally, obviously.
Right.
We've actually now started trimming back a little bit.
Okay.
So the allocations today are actually pretty close because you've had some market appreciation, but we've actually said that's a lot of appreciation. I mean, even today when you have stock markets that are back at all-time highs, there's no COVID effect whatsoever. So we're taking a little bit of profits there. It's about the same today.
All right.
Is there a version of this chart that has where the yields are coming from right now? I mean, what's pushing where are we getting the 5% from?
Yeah, so a little bit higher than you might expect, largely because when we take, well, aside from the fact that our investment process keys on yields as a key component of what drives future returns.
Right.
So it generally likes assets that have positive yields.
Yeah.
We get a bit of a yield kicker because the way we obtain our equity exposures and the way we obtain our commodities exposures and the way we obtain our REIT exposures, we use we call a stocks plus, it's an enhanced approach where we, instead of owning the physical S&P 500, the physical stocks, we get the S&P 500 exposure through a S&P 500 futures contract, which provides
leverage.
the same economic
It's used
return.
leverage, right?
And then
That's called leverage.
Well, we
So
collateralize
we're in levered investments.
I wouldn't.
I'm not saying that being in levered investments is wrong. I just want to know if when you say we're using futures instead of holding the underlying, okay, you're leveraged.
Well, I want to clarify that because that word can have a lot of shock value.
Yeah. I understand.
If you give us $100 in the strategy that I just described,
right,
we can get your S&P exposure two different ways. We can spend the 100 and buy the 500 stocks. Yeah. Or we can keep the 100.
And so,
get 100.
And so what?
Get 100. Well, I just want to make sure for the committee because leverage can mean for $100 you could have $300 or $400 or $500 worth of price exposure. You have multiples of loss potential. That is not what we have in this case.
That's what I'm trying to understand. What kind of leverage do we have in what asset classes? And using that leverage, you can generate more yield. So I do understand that, but doing that also exposes us. It also makes it very important that your leverage bets work out. So I'm just trying to understand where the yields are coming from. How much leverage do we have to get those yields?
So wherever you see equities, commodities, and REITs on that chart, that's where we're using the collateralized futures approach.
Okay.
They're collateralized at a 1-to-1 ratio. So if you give us $100 for the S&P exposure, you're getting $100 worth of S&P exposure. You're not getting 2x or 3x. So there is not economic leverage. It's just that we're obtaining that $100 worth of exposure by combining a futures contract, which does not require a capital outlay.
Right, I got
and
that.
We're keeping and instead of keeping the capital in true cash, we're keeping it in high quality bonds, which still provides a 1-to-1 ratio. It still suffices as collateral to meet the margin calls in the futures contract, but it gives you a yield premium over true cash. And that yield premium is what's accruing at the portfolio to give the total portfolio an elevated yield. So you're basically taking the structural yield advantage of bonds versus cash to give a very creative, inventive, and widely used technique across institutional clients to get a yield premium and drive incremental return.
So we're using a dynamic strategy to move between how much cash, stocks, bonds that we have. Is that correct?
That's a reasonable synopsis. Yeah, that's a reasonable synopsis.
So would you characterize it that we're short options?
No. I would not characterize it as being short options.
Why would you be short? You're not going to be short. Why would you be short? We're long.
We've been managing these portable alpha strategies since 1987, starting with our equity strategies. And we've been pretty well battle tested through the tech bubble crisis, the great financial crisis, and through this most recent one. So we try to manage these with a very tight tracking error and have very tight risk controls. we're only trying to add 1 or 2% above the individual benchmarks. We're not trying to add a lot of additional risk there. And the alpha comes primarily from fixed income investing, which is kind of in our wheelhouse as Pimco, right? So we take risk very seriously as a fixed income manager, and we manage the tracking area very tightly. And we've made it through all these crises, managing it without kind of a hiccup. There may be some slight underperformance in a year like the great 2008 or this year, but it's generally to the magnitude of 2 to 3%, and we generally make it up fairly quickly. So,
yeah, these strategies are top decile performers in their category across the board. They're analogous to active managed equities. Active managed equities, they have a benchmark, and they're picking different stocks, trying to beat the benchmark by 1% or 2%. We're doing the same. We're trying to beat the benchmark by 1% or 2%, but we're tracking the benchmark just like they are, very closely to the benchmark, except instead of trying to beat the benchmark by picking stocks, we're trying to beat the benchmark by holding collateral that has a yield premium relative to the futures contract that's giving us the index exposure. So you get the index at a yield, at an interest rate, and then we can keep the bonds at an interest rate that is a slight premium to what we're paying, and you capture that extra. We don't have to worry about if we pick the right stock or not. It's actually, it's basically the same way a bank makes money. You know, they lend at one rate and then borrow at another, and they keep the VIG. It's structural, and that's why it's been such a successful strategy. We're not levering the portfolio. It's $100 worth in, gets you $100 worth of the S&P exposure. We're just obtaining it in a way that allows you to capture that yield differential. That's basically, like I said, the same profit model that a bank uses.
Yeah, but banks lend long and borrow short, and that hasn't worked at times.
It's analogous to a banking model.
I'm sorry, you use the banking, the banking as an analogy, and I'm just saying there are times when it doesn't work, and the Fed comes to the rescue. I mean, that's fine if that's what we're doing. So I just want to understand what we're doing.
It's fair. It's not that extreme. Actually, it is accurate. In this case, we are borrowing at an overnight rate. Actually, it's a 3-month rate. And then we're lending or earning interest at what's probably on average a 3-year rate. So it's a 3-month versus a 3 to 4 year differential. That doesn't sacrifice much in quality, but it picks up a lot in yield.
Oh, yeah.
So it preserves, and that's the basic strategy. I mean, if you're really going to overly simplify it, but that's it. Yeah.
And if the Fed's going to make sure that keeps working, which they said they're going to do, it looks like it's reasonable.
Yeah, you're right. As long as there's a positively sloped yield curve, that strategy is an absolute winner. And the Fed, as you mentioned, or someone else on the committee did, they just affirmed to being at zero for quite a while. So there's going to be a positively sloped yield curve for a long time. It's a great structural strategy.
I think I understand. Thank you.
Yeah, no problem. Yeah, interesting sidebar, and hopefully illuminating for the committee as well. Any other questions?
No. One other thing I'd just like to point out is we talked a lot about inflation protection, and that's certainly one of the key tenets in the strategy. We talked a little bit about value, but if value comes back in favor, it's not only good for Silchester, but it's good for this strategy as well, because primarily how we invest in the equity strategies is a value orientation. So,
yeah, and I'll say value versus growth is at the 100th percentile, not at top, not the decile. It's at the 100th percentile. It has never been cheaper relative growth. So there's another coiled spring that's in the portfolio, to Kevin's point.
Okay.
I mean, if there are no other questions, I want to thank you for your presentation.
Yeah, thank you.
Any other questions from anyone?
Yep. Thank you.
Thanks for the long-term partnership. Thanks for being a client.
Thank you.
Thanks for your time, everybody. Signing off.
Thank you.
Okay.
Anybody have any comments?
Took a long time to get that we're borrowing short and lending long.
I agree with that.
I think the problem that we have with it is there is no real true benchmark with this, but the real reason, I think the reason why we're in this fund the way we are is we've been looking for inflationary protection in a liquid asset, and we've guided away from the private equity and the infrastructure, the non-liquid, the Pantheon type stuff. So I think that's the reason why we're in this to begin with.
Yeah, Joe, this is Tom. I would just say that that's a good summary. I would add to it that diversification is also a benefit of this strategy. If you think about, they use the term third pillar, which I like because it's a way of simplifying all the exposures they're getting that are mainly different from what you're getting elsewhere. So there is diversification in addition to the long-term inflation hedging. I think the benchmarking is really difficult because it's so much broader than TIPS. It's more volatile. And I think these CPI plus benchmarks are fraught with peril because they use the term aspirational multiple times. No one can achieve CPI plus 5 without taking risk. And the risk that you need to do to achieve it is going to create a lot more volatility. So you get a lot of tracking error to that type of benchmark in the short to medium term. And so even if you hit it longer term, you're going to have periods where you're way above or below. And part of me wishes they didn't use it at all. A lot of managers do these types of cash plus benchmarks, but they create, I think, a lot of performance measurement issues and a lot of confusion. So in a way, I'd say we leave that aside, other than that it does reflect the fact that they're trying to generate a real return above inflation, which they have done. But other than that, I don't think it's that useful.
I think the reason why we had them come in to give us this presentation also had to do with the OPEB. I think we were discussing whether or not to bring them into the OPEB allocation, if I'm not mistaken.
They are in the OPEB. Yeah, so
okay.
it was exactly that, Joe. It was the idea that infrastructure is winding down.
Yep.
Do you want to have more private illiquid inflation hedging, or do you want to keep what you have, which is, to your point, daily liquid inflation hedging and much more transparent, right? We can see all the underlying components of it. So I think there's a lot in favor of the liquid daily valued versus the decade or more fund tie-up with much higher fees.
Have they been using the term aspirational for a long time, or did that come into play recently with this year's performance?
In my experience with them and other managers, anytime they're not at it, they will weave that in, something to that effect.
Yeah. Okay. Yeah. I was wondering that.
You know, what concerns me is that, you know, it's one thing to say CPI plus 5 when CPI is 7 or 8% or 5%. It's a lot different to say CPI, you know, then you're only saying, okay, I'm only going to, you know, outperform by CPI is 5%. I'm going to give you 5% over that, so I'm only going to look to double CPI. When CPI is 1%, I'm saying I'm going to give you CPI plus 500. That's 5 times. It's you don't get something for nothing, and you do that by getting, you know, by taking more risk. And so, you know, that's, you know, the CPI plus 5, I think, is outdated.
Yeah, and it's probably going to be outdated for the next several years.
And I just hope that they're not, you know, you know, that, yeah, you know, leaving the argument about things are cheap, so future returns are going to be better aside, you know, in a world where we're seeing yields close to zero on government bonds, where do you go to generate real returns of like 5%?
Yeah. All right.
Any other discussion?
Nope.
I just wanted to make one other point here. I just wanted to mention Hooker and Holcomb, who's been our actuaries, their contract was for 5 years. They did not submit a proposal for to be considered for the next 5 years. And so we're in a search right now. We've reduced it from 7 firms who submitted to 4. Henry, Ray, myself, Chitsame have interviewed some. No final decision's been made. But when it's made, all the candidates are very competent, and we will announce it to the board. Any questions on that?
Nope.
We did the performance review, and so if anybody would like to move for adjournment.
Move to adjourn.
Second.
Is there a second? All in favor?
Aye.
Aye. Motion passes unanimous. Next will be, hello, Henry.
Hi, Frank. Frank, I thought we finalized the decision-making.
Ray, go ahead.
Yeah, Henry, on my advice, I said to Frank, until we have the contract signed, and if we do, it's news to me, until we have the contract signed, we shouldn't publicly announce that we have a new actuary.
Fair enough. That's fine.
One other thing before, I guess, is Charlie, are you on? Only because I want to know who's in attendance.
Doesn't sound like it.
Okay, so
It looks
there was
like
a motion for adjournment and it's passed. So all in favor, everyone was in favor. So that meeting is adjourned. Next is the OPEB meeting. Want to call the meeting of the OPEB for Wednesday, June 10th, 2020 via teleconference. They would like to approve the minutes for the meeting of December 11th, 2019.
Motion to accept.
Is there a second?
Second.
All in favor?
Aye.
Aye.
Passes unanimous. Opposed? The IPS review, is that you, Britt?
Yes, thanks, Frank. So if you recall, the last OPEB meeting, we presented the asset allocation study in December. And in conjunction with that, the board hinted at a new asset allocation. And before they adopted it, they wanted the IPS, you wanted the IPS updated and for us to come back with some potential rebalancing. So kind of step one here, taking a look at the IPS for the OPEB. It's been a few years. We made a few minor edits. You'll see on page 5 under social investment policy, we updated one word to be consistent with the pension IPS. And then on page 10, we have the new asset allocation that was presented to the board in the asset allocation study. And if you recall here, we are making some slight changes, increasing equities. So domestic equity, the current target is 37%. The new asset allocation, 41%. Within international, the previous target was 25%. The new target, 27%. Fixed income being reduced from 28% target to 20%. And Pimco being increased from 10% to 12%. and we adjusted the ranges accordingly. I think we kept the fixed income range a little narrower to make sure that that anchor to windward remains relatively close to that target. But this reflects the new asset allocation that the board was interested in, and happy to answer any questions. I'll leave it there.
I think it looks fine. I'm good with it.
What, the one question I had was the total equity, the upper limit, what is that now?
83.
83.
Right. And the upper limit for the domestic would be?
51.
Right, and then the upper limit for the international is 34?
Yep.
So that's 75. So we could never be at 83. If we're at the upper limit, both domestic and international. Oh no,
We'd
that's
be at
right,
85. Yep.
85. Okay,
And we can adjust the limits if anyone has a desire to. We try to keep them reasonable and give the board enough sway on each side to make sure that you could make adjustments as you saw fit.
anybody have any recommendations, or is there a motion to accept these changes?
Yeah, one quick question, I guess, for Tom or Britt, are those ranges, wider than you typically see, particularly on, I mean, that's 30 point spread's pretty big on equities. Is that kind of unusual, or is that all right?
It's definitely at the high end, Jim. So
Yeah.
we could tighten it up a little bit. But you've got to remember that it also does get governed by the other ones too, right? Like if you have fixed income at a tighter range, that actually serves as a governor to an extent. But yes, they could be. US is pretty broad, right? And the overall is definitely broad.
There's no downside to having it wide.
No, I agree. I'm just curious if we were really putting out something that's kind of unusual, but as long as we're not being, too far from what's typical, I'm okay with it.
Tom, one of the things I think you talked to us about proposal for changing, some of our investments within OPEB. And should we include asset allocations? We have asset allocations in the regular pension plan that are at, say 0 to 10. Is there any asset allocation that you might propose in the future that we don't have now on this asset allocation page?
No, I think it's good for now, Frank. You mean in terms of giving flexibility for other asset classes? I think we would do education first, and then it would be added. I don't think there's a need to add asset classes that you don't invest in right now.
Okay.
Yeah, it is well diversified already, which we confirm with the asset allocation study. So I know what you're saying, but I don't think it needs to be memorialized in the IPS right now.
Thank you.
What about, should we have something here for cash?
Well, there are no cash needs at this point in the OPEB that we are aware of.
Yeah. Okay.
And that can always be amended as
Yeah. All right, we're
this
good.
fund pays out.
Yeah. All right. I'll make a motion to accept this.
Second,
Is there a second?
second.
All in favor?
Aye.
Aye. Opposed? Passes unanimous. Next is the performance review.
Great, thanks, Frank. Everybody has the OPEB flash. I'll turn to page 1, and in conjunction with this, we wanted to bring a rebalance recommendation based on that new asset allocation that was just adopted. And on page 1 of the flash, you can see OPEB at about 96 million at the end of April. Total equities about 65%. You can see domestic equities about 41% versus the target, the old target of 37.5. The new target is 41, so pretty much spot on there. International equities 24.3 versus a 27% target. Fixed income about 25% versus a new 20% target. And Pimco under the liquid real assets target of at 9.3 with a new target of 12. So what we did was we took the April 30th market values and embedded the benchmark returns through May. So for the Vanguard total stock market fund, taking the Russell 3000 as a proxy. So the month to date return for May was about 5.35%. We took the ACWI ex-US for the international stock fund, the AG for the fixed income funds, etc. Long story short, not a lot has changed. Equity markets were up in May. The AG was up about 0.5%. And to bring things in line, we suggest taking 5 million from fixed income and contributing 2.5 to the international stock fund and 2.5 to the Pimco all asset fund. And within the 5 million, we would suggest 3 million from Prudential and 2 million from MetWest. And that should bring the OPEB in balance with the new target.
Is there a motion or is any discussion on that?
No, I think that's pretty reasonable. So motion to accept.
Rich, can't hear you. Rich, get closer to your mic.
Get closer to my mic. Is that better?
There you go. That's much better.
All right. So I move to accept the recommendations.
Is there a
I'll
second?
Second.
All in favor?
Aye.
Opposed? Passes unanimous. Either Chitsame or Henry, could you tell us what the amount of money that would be coming into OPEB in the next fiscal year?
I would defer to Chitsame on the budget numbers. I know the pension amount, I mean, we have them budgeted and we're planning to inject them in the beginning of July. So we get a full year. I don't have the details in front of me.
For the OPEB contribution, is that the question?
Yes.
Okay, for fiscal year, I have the report with me. For fiscal year 2021, it's about 10 million. What we do with the OPEB fund is we basically fund as you go. So we do pay OPEB insurance and other post-employment benefits out of the fund for accounting purpose. So we don't fund all of that amount to the pension trust fund all at once. We use it, and then at the end of the year, we analyze the difference, and then the difference in the amount that goes to the pension trust fund.
So
you
the
don't-
funds would, so any funds that would be going in to OPEB would be, we would know about next June?
I
Or
think,
so?
right, once we get the audited numbers, then we would know what was in the, I want to say in the prior fiscal year, we know the difference. And then once we get the audited number, then we would fund that difference and send it to the OPEB trust fund.
Thank you.
Have an amount for the 2019-2020 fund now?
I think we sent that already. I just don't have it in front of me, but I'm pretty sure we sent the 2019. I want to say it's only remember exactly the date, but we definitely send that amount to the OPEB fund. But I could get that for you.
I think I remember doing something.
Yeah.
Did I hear,
Any other discussion?
I was saying, did I hear Charlie speaking just a minute ago?
Yes.
Yeah, I did. Frank, I don't know if you weren't on for the part of the, when Frank took attendance for you. Did you get him here, Frank?
No, I just wanted to make sure, Charlie, you're here. We just want to make sure that for the minutes that you're a member.
I'm here.
Excellent. And do you have any questions or discussion or points to make?
Nope, I've been here since the beginning and everything seems good so far. Smooth meeting, Frank. Good job.
Hey, it's 7:41. I get another 20 minutes into the bank.
No.
Now you're pushing it, Frank. You're pushing it.
Is there a motion to adjourn?
Motion to adjourn.
Seconded.
All in
All right.
favor?
Aye.
Unanimous. Thank you very much.
All right.
Bye, everybody.
We'll be in touch with people as far as if there's going to be a meeting during the summer.
Hey,
Okay.
Frank,
Yes.
my sandwich delivery didn't come. What's